Today we have Professor Manish here with us at Invest 21's office. Thank you for being here, Professor Manish. It's lovely to have you here. Yeah.
Thanks for inviting me.
Yeah.
It's my pleasure to be here.
Yeah. So I believe we first met 6 years ago. We were kind of fancying this idea about doing something in finance, starting a prop firm, or writing anything about markets or finance in general as such. And now when I kind of look back, it's been 6 years plus, and today here we are. We started a securities firm. We are an MSc and a BSc member as of today, and we look forward to building broad capabilities at the firm here itself.
Yeah, I distinctly remember in 2019 when we met. I think sometimes off the pitch, sometimes on the pitch.
Yes.
We also played football together.
Yeah.
I still remember.
But it was lovely back then, we were just two guys who were just passionate about markets, finance in general as such, and and we've been going back and forth, but we could make quite a bit of progress, and I also built a small team around us, which is pretty strong in terms of operations, core finance, research, etc. So now heading to the topics, there are certain topics that I would like to discuss with you. Different investment asset classes, what is the future of it, and general economy as a whole. So the first thing, you've done a lot of extensive research when it comes to fixed deposits, gold, finance, corporate finance in general. What is your take on fixed deposits in a background scenario where high interest rates don't seem to be sustainable any longer? So you have the era of a high interest rate seems to be fading out. So in such a scenario, how do you view FDs as an investment for a youngster who has a 40-year or a 30-year long career for investing? What's your take on that?
So I'll go and take a step even back. And my sense is the way we approach finance, we need to rethink about that and recalibrate it as per our growing economy. So most of the research in finance, we take finance in America as given, and then we do translation of that research for an emerging country like India, and we say, okay, this works there, so it will work out here. What we don't get is, if you go back, like 30 years back, 1993, India is a $250 billion economy. Today, you are a $4 trillion economy in a span of 30 years. I think there are only 6 countries in this world which have done this journey, where in the 30-year span, they have gone from $250 billion to a $4 trillion economy. And what is more amazing is that there are very few countries, and I think except for US and China, there is no other country which will see the transition of India from a $3 trillion to a $30 trillion economy in the next 40-50 years. So instruments, things that were applicable 30 years back in 1993 are not going to be the same instrument that is applicable today. Whether it is real estate, gold, fixed deposit, or any other asset class for that matter. You need to keep on evolving. Every 10 years, you have to go to the market, take stock of what all instruments are there, which is available, and then rethink, rebalance, re-strategize to live for another decade. So it's not just about fixed deposit, even real estate. In 1993, you buy a house, it would have given you a tremendous amount of capital if you have invested there for 30 years. Will I gain the same if I invest today? Or will I gain the same when I invest in 2050 in real estate? I mean, these are three very different questions. 1993 India is very different. Very poor, but very fast growing, tremendous potential, but politically unstable. Today, you have got political stability, rule of law, very well functioning market, a lot of pipelines getting fixed. You have potential to grow in finance. In 30 years' time, it may or may not materialize, and then maybe you need to rethink about it. So my take is, coming back to the instrument like fixed deposit, 30 years back, it was giving you an interest of 12%. Banks were the only one which, in the name of finance, we had only financial institution in the name of banks. There was nothing else. Couple of NBFCs were there, but they were very risky. Brokerage firms were marred with a lot of issues of corporate governance. A lot of this is cleaned up in the last 30 years.
In terms of structural compliance as well when it comes to market institutions.
Yes.
The sort of progress that we have made is amazing. I mean, it also brings a great deal of credibility to small players in the system as well. So, in terms of structural default when it comes to market institutions, in that scenario, I would say almost default is nil to the best of my knowledge as of today. So, you do have, I completely agree with you, and you do have a lot of other asset classes where you need to venture. A simple example that I could probably give from my experience being in the markets for a while is that our research also suggests that when you think about equity in the long run, like about let us say 20 to 40 years of time frame, and you even distribute volatility over these years, it's least volatile, and no asset class usually matches the sort of returns that cash can bring to you. Anyways, this one we will also touch upon this at the end.
Agree. I also think that, see, you can do a full conversation on institutions in India that India has built.
Yeah. Yes.
So there's a very nice recent paper written by Ajay Shah on last 30 years and the major reforms that were done in India.
Okay.
So very plain, simple, clean 15 pages about 15 different institutions or major reforms in finance that changed the shape of India in the last 30 years. And this is what I'm saying, 93 is very different from 23, and the reason is because a series of institutions like SEBI, NSC, NSDL, CDSL, CCIL, a lot of institutions came in that ensured that slowly and steadily finance is being pushed to the masses with a reasonably nice public infrastructure.
And these institutions are now natural assets. It's very hard to replicate them.
Yeah, and even a lot of other countries are thinking about replicating them, but this is not going to be easy.
It's a long drawn out process.
It's a long drawn process. It has taken a lot of human capital to build this.
Yes.
Figure out this kind of capital, like human capital, people who know all this. So one of the beautiful things about India is it has a young population. It has a lot of people who have lived abroad, went abroad, studied abroad, came back, came with a lot of human capital, which they deployed. Also, the people who never went abroad or studied here, they also are competing with people, or they always think about competing with people at par with US. When you build a Flipkart, you are thinking about competing one day with Amazon. So you have to bring your best. Otherwise, you will not survive. You know that Amazon is coming next. So you have to do that transition. I think this is amazing that we have stood, and at least the young people have stood, and they have started fighting. So this means Indian homegrown companies have used this infrastructure so well that now they are in a commanding position and they actually can venture out now and make a mark for themselves even around the world. So that's a great thing. It's a great transformation where being a receiver to our young people going out and making a mark left, right, and center.
Now coming to the banking sector, there's a particular question that I want to ask. Is that, for banks, cost of deposits is going up and they're unable to match the aggressive demand for credit from consumers. And given this scenario, there is a little bit of squeeze that is taking place in bottom line numbers when it is coming to interest income and etc. What do you think banks need to recalibrate, think about, treasury income, earning money through other financial securities market as a portfolio diversification? What's your say on this aspect?
There was a very interesting research by Deutsche Bank after the global financial crisis, where they said that banks should go back to do banking based on public deposits. It's lovely that 10, 15 years down the line, we go back and say, please stop doing banking based on public deposit. Do banking based on more than public deposits. And this is a very interesting development around the world. So if you look at US, banks usually have 60, anywhere between 40 to 70% of their liabilities in the form of public deposit. They pay a zero interest rate. Actually, you pay to the bank to maintain a bank account. And the remaining 30 to 60% of the money they raise in the market in the forms of bonds. So they are competing at par with any other firm or financial institution out there to raise money, and that money gives them leverage to do credit. In India, banking was always about state control, state directing money via banks. Actually, when I went abroad, one of the surprising things that I found is that in India, when you release a budget, you roughly tell what banks are supposed to go in the next 1 year.
Okay.
This is very interesting because this means you roughly think of the government finances and the bank finances roughly in line with each other, or somewhere they are not completely disaggregated. They are one and the same. So now what we are seeing is like all banks, at least the public sector banks, have 80 to 85% of their liabilities pure on public deposit. And they are not allowed to raise bonds. They are not allowed to do a lot of other things, which even NBFCs are allowed to do. And that has something to do with a lot to do with the bank stability in general. What we are seeing right now is basically you have some squeeze from the central bank because you worry about inflation, and we are trying to anchor inflation to a slightly lower level than what is the historical average. At the same time, there's a huge credit demand. And both of these cannot go in line easily. So there's a small bit of tussle between central bank and bank. You can see this as a problem, but you can also see this as a growth. Like actually credit demand in India is not shrinking. It's very robust. People want credit. They have the infrastructure to get credit. And there's a lot of action which is happening there. So I think we should watch it very closely how this will turn out. But my sense is this is not something bad. There's a good amount of credit which is available out there. There's very strong demand for credit. Some worry is there because we have never seen retail credit as big as it is today. And because there's no historical precedence, we don't know what is happening. So unless some default numbers will come up, some NPAs start rising up, commenting on this will be very, very hard. So we should watch it very closely, like what happens when retail credit as a proportion of total credit goes to this extent. But I will not worry about it at this point.
Yeah, I completely agree. Because when we were doing our study, and we found that banks have been performing very well of late. And in fact, I think some of the best quarters are yet to come for these guys. And a lot of restructuring and the initiating trust that was given by the central government on this behalf has been just amazing in terms of restructuring and so on and so forth. So in terms of, as a sector as a whole, they're in a very healthy shape. But the best is yet to come for these banks. And I've also noticed that the central government shareholding in the banks has been systematically going down. They want to kind of consolidate the banks put together. And you're seeing this, and this, kind of unlocks the free flow of a bank, creating a better market price in terms of, when you go to market and stuff. So this is something that is on a positive note and stuff.
So recently we wrote a paper which is about financial stability of banks. And if you look at the long-term trend, there's some struggle that we are not able to get out from. So number of banks in India is shrinking, and it has shrank drastically. So if you look at the last 75 years of India's journey, we are coming down from roughly around 600 banks in 1950 to 32 public plus private sector banks today. So what happened to the remaining 570 banks? So I'll say it's a long journey. We have seen a lot of things went left, like went haywire. In the last 30 years, we have seen failure of around 40 banks in India. And it's not just they are all public sector banks and non-performing and things like this. There is, I think, in the last, after 1998, I think there are 14 bank licenses, if I'm not wrong, issued. After that, 5 have failed. So this means the death rate in a banking sector is very, very high in India. And entry is very limited. So when you have no entry and banks keep on exiting because of either failure or merger, or government thinks that small public sector banks should be merged with large public sector banks to take economies of scale, things like this. Something is happening, there's a tremendous amount of change, but I'll say on average, banks in India have become far more stable, but they have also become far more big. This is going to create an issue where asset is getting concentrated in the hands of top 5 banks, and top 5 banks in India hold roughly 60% of overall banking asset in India. This used to be around 40, 43% 10, 15, 12 years back. So this has consolidated. This is going to have serious implications when banks become that big.
But this is only natural, right? In the long runs of a competitive environment, you have the best guys taking the larger chunks of the market share, or you can't really stop a big bank growing even bigger because the scale of operations also expand. Now you are funding, at some stage you are going to fund states, some states different organizations. So the scale has gone too big. So how big for a bank is being termed as big?
I don't know. As I said, I really don't know. My concern is very simple. See, if this was the case, that just by consolidation, banks become safe, then we will not see this much failure. Because there is a consolidation where we see some amount of stability in the system, but at the same time, a near continuous failures. Then it is worrisome. Am I saying that at the end of this, 50 years down the line, if I have to predict, we will have 10 banks and other will just die because they will not able to compete at that scale. So maybe it has scale economies and only above a certain scale you can compete. Otherwise, you have to just merge or get out in some way.
But it's the very nature of banking industry to take risk on. Right?
I'm not denying it. But I'm saying, imagine you're a small bank fighting in this league. Then you have no other option but to take risk. So you're basically, in a certain way, it's gambling for resurrection. Either you become big or you go down. Okay. And I'm saying, you see a lot of players going down, then you should think about it whether this was the plan. If I was a regulator, I would think that I would issue more banking licenses so that at least reasonable number of banks are present at all times. And because when you issue a new license, usually you are issuing it to a small bank. So failure can be handled easily. So
you are of the opinion that you need to have more number of players in the market.
You should maintain at least certain number of players just to make it competitive. Otherwise, you might suffer on competition at some point in time. They may become very big and they're like, now I don't need to.
Rest of the
it's like monopolistic power. You become a monopoly and you say, I'm not worried about all this.
Given this background, recently we had RBI voicing concern with respect to falling deposits in the system. And we were just wondering, some of the part reason was being given by different sections of regulators was money was flowing into markets. There are other schemes which offer as deposits and so on and so forth. Do you think it's a point to worry that deposits are shrinking with banks?
So I will not say it's not about being worried. See, if you read basic monetary economics 101, money cannot leak out from the system. So if money is created, it's going to be deposited in one of these banks because they have the monopoly power to take deposit. There is no other institution which can take deposit. So doesn't matter, I buy mutual fund, I buy bond, this, that. End of the day, that money has to circle and go back to one of the bank accounts.
Into the financial system. So it's not going to go into a vacuum.
Yeah. So it has to come back. The question is, can it support the credit growth? That's a second order question. And I'm saying the credit growth demand is way higher at this point in time compared to the deposit growth. And this can be filled by taking extra credit from RBI, which banks can do, and generate more money in the system.
It also kind of puts stress on CASA ratios.
Yes, but this is where we are struggling, where central bank is a little uncomfortable generating this much credit, given that they have already expressed their opinion that retail credit is risky and the proportion of retail credit has gone way beyond what we have historically seen. So I'm saying there are two different people in the market who are looking at this situation differently. RBI thinks that you have already entered a risky territory where you should be concerned. Bank is saying, so far I'm not seeing any default or default of that magnitude that I should be worried about it. So I would like to keep on continuing this retail credit.
But don't you think this is also something that has to do with our societal characteristic? We are, as a whole, we are somehow not comfortable growing on credit. What do you think? Does that have any dimension to
So
offer to that?
yeah, so I'll say I teach a course on debt and default, and a major part of that course
Yes.
is about morality of debt.
Okay.
So debt, all said and done. Anyone giving you debt, you always feel like moral obligation that you owe him something, and you have to return that money in some way. So it's more than finance. It's not just that I gave you money and this is, you also value that you gave me money when I was in trouble. So it's not just about money. It's about relationship. It's about, I don't know, it's more than
There are
money.
far more intangibles associated with it.
Yes. And it goes very deep. You're not making decision here. You are making decision here.
Yeah.
Like I should give money to someone.
Yes.
So, taking that out from financial system is very, very difficult. That it goes back to you have a list of willful defaulters. What is a willful defaulter? If you think about default, can be broken down into two problems. One is ability, one is intention. Okay. The job of finance is to assess your ability. Intention, nobody can assess. How do I know at what point it will change? You can give them nice words, moral hazard, information asymmetry. You can have fancy terms explaining this. But the fundamental problem is that intention is very, very hard to assess. And you never know. So you can always blame it on my intention. Tomorrow morning, I'm an economist. Okay. Imagine I work, I take a loan of 20 lakh rupees. And I meet an accident where I lose a hand. Okay. I have one hand remaining. You can always argue that you can work with one hand and pay back 20 lakh rupees. Right? Or you start working with legs, I don't know. So you can always argue in a certain way, like if I have the intention, I will figure out a way to pay you back. But should it be done? That's a different question altogether.
No.
Yeah. So I think it's a very, very hard question. And I find it very tricky. I think it should always be assessed on ability. And if by intention you default, you put a CIBIL score, you make sure that the guy never gets credit again, and things like this. But you should not go after the intention. Assessing intention is going to make finance very, very difficult.
On that note, let's move on to the next topic of gold. I believe you have extensive research papers written on gold as an asset class. Do you think gold is an instrument for wealth creation or preservation of wealth?
So in my honest opinion, I think that gold is for preservation. It's a hedge against almost everything that can go wrong. So it's a hedge against political crisis. It's a hedge against financial crisis. It's a hedge against the world market going haywire. So if you want some amount of your asset to be independent of everything that happens in this world, then it's a great asset to park your money.
So what would you suggest? Assume a youngster or a working class professional who has about 10 lakhs, then he can afford to part ways with this money. How much do you think he should probably allocate to gold? Any idea? It can be on the basis of preferences, but how would you like to do that?
So we wrote a paper 2 years back, I think 2022, early 2022. It was funded by Dwara Research on why Indians invest in gold. And we wanted to understand something which is beyond the social and cultural aspect of gold. So one is socially we like to hold gold, we want to wear gold, it looks nice and things like this. And culturally we have inclination for this. India, China is the biggest buyer of gold for some reason. But we thought All of this is fine. But it cannot be that I keep on holding on to asset class without being compensated for the risk associated with that asset class. So we did a detailed analysis, look at last 30 years of India's data. And we try to quantify if I had to, believing that whatever the technicality of this variance covariance matrix structure, returns, blah, 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 what proportion of money you should have invested in gold. And you will be amazed to know that it comes out to be around 30 to 40%.
Wow.
And this is an analysis which is where real estate is not considered. So we are only considering gold and Nifty.
Okay.
So we are not considering any risk-free asset. We could have added that also.
Okay.
So I'll say only between, if you consider gold as a risky asset and Nifty as an overall broad market indicator, then, and you compare the total return Nifty index versus gold returns, it's amazing how close gold comes to Nifty.
Really? I was under the impression that, inflation adjusted gold has been giving zero returns.
This is true for developed countries. So if you look at US, they have data for the last 100 years. Inflation adjusted return is zero.
All right.
So this basically gold is giving exactly what short-term treasury securities in US yield.
Okay.
Extremely flat, nothing. But it works as a very good hedge against financial crisis for US.
And on this note, I would like to ask another question where India's central banker has not been adding up much of gold to its reserves. It's been adding up more of dollar as a reserve. And and often given this context where rupee is being given a thrust to kind of act as a replacement for this. Is the foundation rock solid for that?
This is a very difficult question for two reasons. One is research in terms of central banks' holding of gold versus the value of currency. What research says versus what you observe in reality are two very different things. So I'll give you an example. Think about what are the best currencies in this world at this point in time. So you have US dollar, Deutsche Mark, which is replaced with euro now, British pound, some extent yen. These are the four major currencies which are used in world trade. 80% goes in dollar, remaining goes in euro. And JPY has a high value for a very long time. It was the second biggest economy for almost 70, 80 years. So it still commands that position in the international market. Everyone says they are all fiat currency. But their gold holdings of their central banks have risen tremendously in the last 40 years. Even Germany has very high amount of gold holding as a central bank. Then the question is, if all of us believe that these are all fiat currencies and there is no correlation whatsoever with the gold, why they keep on holding gold every few years or every 5 years, every decade? I don't know. It's tricky. Second is, as an emerging country, should we hold gold? So for us, the trade-off is very different. If we hold US dollar, it can be used for trade. It can be used for other things. If we hold gold, then it's a two-step process. Convert gold into US dollar and then use it. So there's a transaction cost associated with this mechanism. So I think we have to think differently than the rest of the world. And I think here theory and research have diverged drastically. And I don't know, not most central banks release those numbers easily. There's some amount of discomfort related to talking about gold at that scale in general. And yeah, establishing a real link between gold versus the currency at this point in time is very, very hard.
Coming to mutual funds. So, do mutual funds excite you?
Yes.
Okay.
So basically, active investment excites me, and I like to write about this in general.
Okay. So there are a lot of schemes, there are 1,000+ odd schemes in the country run by different agencies. It's very hard to choose what is curated and what is best for an individual, though it is subjective in nature. Because for some ETFs might be good, for some top 100, or small cap, mid cap. There's a lot of action that is taking place in thematic sectors as such. When you see that major portion of funds, if they are heading into business cycles or thematic schemes, do you think this is kind of risky for investors, or take advantage of the right of the way of the business cycle?
I'll say this as a four-part problem. Because equity was not always an active part of people's portfolio. This is something which is new. And even in large numbers, if you see, the equity participation of Indians is less than 2% for a very, very long time. Now it has slowly picked up. What it basically means is your per capita income has risen to a place where you can no longer rely solely on the old asset classes like real estate or gold. So think about a young person in India who is in the age group of 25 to 40. He is migrating from cities to cities, renting houses here and there. He cannot keep on holding gold, or 15% of his asset in gold. So he has to think about something else. Either he has to go to gold ETF, or physical gold, or holding physical real estate in every city that you migrate to as part of his job is going to become difficult. So unless he settles down at 40, 45, where he says, this is the city where I'm going to spend the next 20 years, he's not going to do this. So then he has to invest, but he has money, so he has to invest. He cannot eat all that money. So this equity participation is coming, but because it is new, we don't have a solid design the way it is done in other countries. So I'll give you an example. So think about in US, if I have additional money every month, I go. In the first step, I try to figure out what is my risk averseness. How much risk I am comfortable with. Can I invest in mutual fund and sleep at night? If I'm not, then maybe this is not an asset class for you. So within equity versus debt, am I comfortable investing in equity? Am I comfortable investing in debt? That's a call I cannot take on your behalf. You have to think about your risk appetite, your own earning sources, how stable is your other income, how much wealth you have already accumulated, and things like this. So that's part one. Assess your risk averseness. Part two, what proportion you want to invest in risky asset versus risk-free asset. So you want 30% in FDs and government bonds versus 70% in mutual funds. This is the second part. Third part is your composition of the risky asset. So within that risky asset, do you want to invest in triple rated companies only? Or maybe double A rated companies? Or maybe a distribution within them where 40% goes to triple A, 20% goes to double A. This. And the last part is at what frequency you rebalance your portfolio. Because what are the great companies today may not be great companies tomorrow. So it's a four-part problem. I'm saying what we have figured out as a nation is we have built the pipeline for easy investing. Now somebody has to fix all the other four problems, which are finance problems. These are not IT problems. These are finance problems now. So IT is fixed. Moving to finance problem, we have to struggle. And this is where mutual funds come in. So what mutual funds offer is, they are not going to assess your risk, but they will tell you that what is their riskiness based on what kind of strategy they are adopting. So first question, they will classify themselves and tell you, but you have to take a call, which one you pick. Risk-free versus risky asset, they are not going to tell you anything. Once you choose a risky asset composition, then again you can pick a mutual fund which suits your risk profile in a certain way. And rebalancing is something where mutual funds are good because they're active players. So they constantly look at market and they do this. Over time, talking to a lot of people who work in finance or who have reasonable portfolio, I have realized that one of the big problems we suffer as a country is we don't rebalance our portfolio that frequently.
You have to churn.
And that's where I think mutual fund add tremendous value. That imagine I make for 30 lakh rupees a year. I have to every month invest a lakh rupee or 70,000 rupees every month. I can keep on investing this money based on which are the best performing stock in that month. But then over time I'm accumulating a bunch of stocks which might have lost their relevance.
Yes.
So somebody has to look at in aggregate what is Manish's portfolio and what kind of risk he's slowly concentrating on and take some part of it out or rebalance it. So I think this is where mutual funds come in. They constantly look at the market. They're active players. They manage it well. So I think there's great benefit in just hiring a person whose fundamental job is to look at your portfolio in totality at all times.
Yes.
It's not like tomorrow morning I got busy with an assignment where I go to Europe for 3 months and I don't know what happened to my portfolio. There's a guy whose job is to look at that portfolio.
Let the pros do it.
Yes. But my other concern is, which is on the negative side, is I think mutual fund also has the same issues that brokerage firms had in the 90s. Figuring out the right mutual fund and guaranteeing that they are doing things right is very, very difficult for a retailer. And this is where I think securities firms add tremendous value, that they should guide investors as to what is the right mutual fund, because they have the financial strength or the muscle, because they are basically aggregating retailers towards a particular mutual fund. So they have the muscle to actually go and ask hard-hitting questions to a mutual fund or a fund house, saying, boss, I put you this much business, I channeled 4,000 crore to you.
So you kind of have a leverage over these firms.
Yes, so the retailers,
portfolio turnover ratio.
For retailers, they cannot ask hard questions.
Yes.
But a securities firm can ask really hard questions.
As an intermediary.
As an intermediary.
This is the leverage that, this is where a securities firm can bridge that gap between a retailer and to the AMC as well.
Yes.
That's where the mutual fund advisory and distribution comes into take.
So you can make them accountable.
Yes.
A retailer cannot make them accountable. You can make them accountable, which is a great value addition for a retailer.
Yes. So how do you think retailers should approach mutual fund as an industry?
I think this is something that we should think deeply about. If you live in this assumption that you don't have to do anything and your money will grow slowly, automatically, you are living in a very different dimension altogether. Slowly and steadily, as income rises in all countries, people start spending some amount of time doing financial planning. I rarely know a person who makes more than 20 lakh rupees a year and has a financial plan. Nobody actually take out a day in the year, writes about their investments, what all assets they hold, what it is that they think about for the next 3 years, 5 years, 10-year horizon. People have to slowly and steadily start doing this. A plan that is suitable for a person who makes 10 lakh rupees a year is very different from a plan for a person who makes 40 lakh rupees a year. And in a country like India, where incomes grow very rapidly, look at Europe, average income is anything between 1,200 euros to 3,000 euros. But it's very stable. The growth rate of that income is 2%. In India, you enter your first job, it will pay you 30,000 rupees. 10 years later, you will be getting 1,20,000 rupees. You are getting 4 times more money than where you started. You cannot be thinking the financial plan is given. What you planned at 30,000 is going to work out at 120,000. You need to rethink. You need to recalibrate. And you have to recalibrate it more frequently than what they do in the West. This is very, very important. And you have to think. And I think, as we said even before, that at this point in time, for the new generation, holding or investing in real estate or gold is no longer a viable option. So you have no other option but to slowly move into either in stocks or bonds or ETF on gold or ETF on some other assets, REITs and things like this. But you cannot believe that you can go out there and buy a house in every city and you can maintain it properly. And then you can keep on holding 10 kgs of gold and roam around this country with 10 kgs of gold in what? This is not going to be.
It's interesting you mentioned ETF. I would like to ask you something like this. What if the market rally is built by just a few companies and that are leading, which is the case in the US? It can probably be a case tomorrow here as well. In such a case, do SIPs on ETFs work very well when the entire rally is being led by very few companies and all said and done, if something has to go wrong, what will happen to investing in ETF as a whole?
This is something that you have to take a call. See, ETFs are an instrument which gives you better return than holding on to a fixed income security. So it's better than FD, it's better than bonds. It will give you 3% to 5% more in the long run. Okay, so if you invest for 15, 20 years, it will give you 5% additional return every year in this kind of investment. But at the same time, ETFs also suffer. They are diversified. So they are investing in 50 different companies in one go. So you don't expect that this is going to give you outrageous return because the weight of every stock is limited and it cannot be more than 10%. So it does, if for that entire thing to perform way beyond your imagination, at least 10 of them have to perform very well. This is not going to happen. This is where if you have the appetite to take risk, you go to 15, 20 stocks and you take that bet. But then in that case, you should have liquid money or extra money to play this out because there's a chance that it may not materialize and you may lose part of it. So this is for people who have money, who have extra money, which they can afford to invest and take a bet on something that is going to work out. And I'm not saying it's all pure speculation or pure this. It's just, I work in finance. I understand basic finance. I think these are the new NBFCs which have come up, which have solid plan to grow, or new set of small finance banks which have solid plans to go. And I see the potential. Why not bet on my own knowledge and intellect and make a killing out of it if possible? But then if my only income source is like 50,000 rupees a month, then maybe it is very, very hard to materialize this.
Then you choose passive investing.
Then passive investing is good because it is better than doing the bond market, 8% return or FD. Think about FD, you get what, 7% return and then you pay 30% taxes on interest. Net you get 5.5%. India has a historical average inflation of 7% in the last 30 years. This means you actually lost 1.5% of your money. And then the fixed stock of money, you already lost. Okay. So there's nothing you are gaining. So in real terms, your real return is actually negative. It does not make any sense. ETF, even if they give you 8% return, is better than that because you don't have to pay that 30% taxes on the ETF.
So, being in finance and, you must have tracked the latest developments in the industry, the transformation that capital markets have gone through in the last 5 years. The equity participation of households is constantly increasing, which is a great positive, I guess. Because in the developed markets, the participation rate can really go up to 30% from a varying 15 to 30% range. India still today has single-digit allocation to equity as an asset class. So we are kind of just positioned where you're kind of taking off on that front. What do you have to say about that?
I think there's tremendous interest today, at least the age group that I teach, which is between 18 to 25, 27 up to in some cases. There's tremendous amount of interest in finance. They understand the value of investing today far more than it was there in the past. Also, the structure of the economy has changed in a certain way. But I'm not that harsh on people who used to invest in real estate or gold in the past. I always say that the way you look at asset classes, you have to think about the final utility that you derived from those financial assets. So I think about housing. This is a conversation that I always had with my mother. Like why people buy a house? It's very expensive. And my mother says, once you have a house, then the cost of living for you goes down from 20,000 to 2,000 because you don't pay rent. So he says, imagine tomorrow morning something bad happens to you. If you have a house, your kid have a roof. They can live for the next 20 years. They will be poor, but not as poor if you don't have a house. If you don't have a house, they're on the street. So I think buying first house or owning first house is very, very important. It's insurance. It's not a wealth preservation. It's insurance. I am buying an insurance. It's like buying a term insurance.
Yes.
40 years back, there was nothing called term insurance. Nobody was buying term insurance.
Yes.
Nobody even released that information in press that this is something which is important. I remember term insurance came in the early 2000s when this rally gear came and they have this item plan. And suddenly people say, oh, you can simply pay 10,000 rupees or 6,000 rupees and buy 1 crore worth of insurance for 30 years. And wow, that's a great idea. But this was not there. So if I don't have that plan, what's my alternative to that plan? I buy a house. Once I bought the house, I secured that I exist or not. My family always is going to have a roof above their head. I ensured that. I'm saying now, 20 years fast forward, previous generation has done reasonably well and a lot of people have built houses. So their parents have nice houses in some city, somewhere. If you don't have it, then I still think you should buy a house. However small it is, you should buy and hold one small house. Okay. This is insurance purpose. Like if something happens to you, if we are a young country, we travel, we live, we walk, we drive. If something happens to you, your family still has a roof where they can live at a very, very low cost. Because cost of food is almost negligible. 1,500 bucks, 2,000 bucks is enough to live for a month for food. But if you go get the house, you pay 20,000 as a rent. That is very, very difficult.
But the question is also about affordability of real estate. To the majority who are living in the metropolitan cities and in and around, it's gone way out of hands for the majority of us. It's become so expensive that you can compare these rates with that of New York or even Singapore. You may not be able to get the same size, but we're talking about those rates, per SFT being very expensive. In such a case, how do you think affordable housing as a whole can take off over here?
I think this is something which is about consumption pattern in India. Like we give disproportionate weight to housing in a certain way. In most other countries, I think the weight of housing is not that big. I don't know why this is the case, that or maybe this will change over time as we grow and the proportion of money that we save for housing will come down. But I came from a town where majority of the people are lower middle income. They go to a steel company or automobile company, somewhere in the lower middle to upper middle income. But the cost of housing is just outrageous. Rental value is almost zero. But if you want to buy a house, even a small house will cost you 1 crore rupees. And you're like, why people in Jamshedpur want to pay 1 crore rupees for a house? It's a declining city because of manufacturing capital. In the last 20 years, it has shed more than 2 lakh jobs. Why people still want to pay this amount of money to live here? But it's there. And people are ready to put all their hard-earned money in their life buying that one house. Some of this I can blame it to real estate regulations and how this has not worked out for citizens in general. But I don't know the right reason. But we are ready to shell out a lot of money to buy a house.
Yes.
And the true reasons, I don't know. But I also wonder, like you, how this is going to work out and why this is not working out for the largest
One of the reasons as to why I asked you this question is because, there's no real price discovery mechanism in real estate, especially in our country. And, this real estate bubble that burst in Japan in late 1990s, it took a lot of time for it to recuperate. At least in the US, you have house prices kind of having some sort of fair discovery prices, prices kind of fluctuate and so on. Do you believe that we are at that moment where, a couple of years of this irrational speculation in real estate might burst? Or, and also another question to it would be, irrational speculation in real estate is posing a threat and is also transferring risk in its own multiple dimensions.
I have studied real estate from property taxes point of view.
Okay.
I have done some study as to how to think about real estate as an asset class. But when it comes to pricing of real estate, as a researcher, it is very hard to say anything. Because first, it's a very diversified country. So, housing prices have risen up in major capital cities. But the rest of the country, this is not the case. So especially the eastern and northeastern part of India, it has declined actually over time. There's not much growth. This growth you see is only in the southern and the western part of this country. And this is in and around large cities. I also think a lot of this is money flowing backwards. So it's like I make some money and then I ask my father to buy a house in his hometown. This is also funneling some amount of money to those smaller cities where some amount of price rise. But because we don't get any detailed information about market prices, it is very, very hard to do long-term study on this. So recently, some of the cities are starting doing this. So Maharashtra has recently released information where you can actually track every property which is sold and what is the price at which it is sold, what is the taxes being paid on that property and things like this. So they're very interesting that once it starts showing up, it will take 10 years of time when people will start building models, start thinking about what is happening to large cities, mid-sized cities, small cities, and all this. But given the lack of data, I don't think anyone in India at this point in time can tell you the long-term trend in this kind of a thing or how. At least as a researcher, I can say that this will take a while before we can say anything meaningful about it.
Now coming to the point where you've been teaching finance to young kids, and do you think investing today has become far more challenging? Partly, I would say that tech has been a great enabler, but at the same time, uh, moving money on your fingertips has become very, very easy. So, do you think it's more of a behavioral problem, and how do you kind of deal about it, or is it an issue at all?
So I have seen undergrads not doing any investment, so almost all undergrad doing some kind of investment.
Okay.
The interesting part about this is they have all burned their fingers doing this with small amount of money. So it's a good learning experience.
Okay.
When you pay 10,000 rupees, invest in 5 stocks, you burn your money. You want to just be a part of that conversation where everyone invests, so you also put some money.
Yes.
And you learn a lesson at a very young age by doing it yourself instead of me teaching you something. So that's a great thing. That it's something new, something exciting. They all got in, they all burned their fingers, they learned something. What I don't know is how this lesson that they learned today will pan out in their lifetime. So will they learn from here and then they go and when they become a little rich or when they had more money, they will do long-term SIPs, hire a money manager, do it professionally, properly for them, systematically. Or will they forever leave equity market and say, when I was young, I tried this and I failed and I'm going to do this again. I don't know in which direction it will pan out. So it's a speculation. I can speculate. My sense is that majority of them are going to stay to finance. But I also have seen people in my class also who have said, I'm not going to do this anymore.
Because it's very painful.
And especially when you are young,
Yes.
it hurts you.
Yes.
Not here, it hurts here. Like I had small amount of money and I lost 30% of it doing this. So it hurts. Because it hurts, I am very sure some of them will think.
Definitely.
Yeah. But at least the good part is, out of a class of 50 people, okay. Yes. That's super interesting.
Yeah.
Okay. The other quickly don't have an account because they don't have 10,000 rupees extra.
Okay.
In IIT, they are like lower middle or lower income. They come from that kind of family, so they don't have that kind of money even, liquid money. So they have, but they want to be a part of it. This means at least 90% of them have exposure to real finance at a very, very young age. This is a great development. And I give full credit to all these discount brokers, which have built such an amazing pipeline. That if you want to experiment, the cost of that experiment is almost zero. This was not there in the past. To do an experiment, it was costly. So you first have to make money, then take a reasonable proportion of your money to the market, then only you can do something. Okay, at a fingertip, $1,000 you can buy your first 2 stocks. You don't need anything. Just 5 minutes of your time and you can buy your stocks. This is like going out for a drinks or with that money, one day you don't go out, you can buy 2 stocks.
Yeah. So Manish, I would want to ask you something. When it comes to casual conversations about markets, of late, it's become the subject in social circles and etc. Where everyone's excited about the sort of market participation that is taking place, which to a large extent is also systematic. A lot of participation in the market through retailers. I understand that it has nothing to do with what financial academics has to teach. There's a lot of divergence between what is generally spoken about and what the subject has to offer. What's your take on this?
I think of it this as a two-part problem. First is more relative demographics in India. We are a very young country. Average age is 29, 30.
Okay.
The financial pipeline is fixed in the last 10 years. So a lot of new and very young people have come up. It's also the same age in which social media has risen to its peak. So there's a lot of hue and cry, noise, in general conversation, 500 WhatsApp group about investment finance. This is happening. Fin influencers, this, that. Difficult. I am 40 years old. I think this is very noisy. This amount of noise was not there when I was young. That's one part to it. But the second and the more serious part is, in finance, academia, or research also, we are not sure about a lot of these things. So to give an example, if you go to advice to retailers, if you read American literature, it's beautiful. There are very interesting papers written. There's one paper came in the early 1990s which said, advice don't work. It doesn't matter what you advise as a securities firm to your client. It's not going to work out. Then there's a bunch of, you can see SEBI data on 90% of the people who are investing are losing money in the derivatives market. So all these young people, even if they know that they're going to lose money, they still want to take that risk and play it out. You are young, you have the risk-taking ability, you want to burn your own finger, you don't want to listen to advice. You see the record of financial literacy. This has been taught last 50 years that you should be financially literate. There are people who have run surveys where people have given information about this is what happens, this, that. Nobody is listening. So financial literacy by force is not imparting knowledge. You given serious professional advice is not able to manage your money. Then it is very hard that what it is that as finance professional you should do, or as a finance researcher I should do to ensure that people learn finance properly. And because there's so much ambiguity where there's no answer, it's open. So it's going to be noisy because there's no final word.
But this is, at the same time, this is an age-old problem. Speculation is not new to markets. And you cannot take away speculation also from markets. It's in fact an integral part of the market in terms of market making or so and so forth. When you kind of do this, and if you have to go back even 100 years ago, you cannot eliminate that from markets.
No, but I always say, see, there is a wrong notion about speculation. There are some terms which have negative connotation. If I say the same thing is taking information advantage, they'll say this is okay. What is speculation? Speculation means somebody is ready to put money on the line, assuming that he has some new information which can be exploited. It's like if I am the guy who learned programming first, should I not work as a programmer? I should. But the first time when somebody does it, it's a bet. Programming may become a great industry, programming may not become. So certain things are named in a way where you, by nomenclature, assign a very negative connotation to it, which is not true. Speculation in reality fundamentally means that people who have access to some additional information are ready to put their own money on the line. The challenge is when they put someone else's money on the line without their consent. These are two very different problems. And you cannot combine both of them and say all speculators which are out there in the market are doing this. This is not true. If this is not there, then people, why I will invest money to gather information about anything? if I cannot exploit that information, then I'm a passive receiver of all information. Then you say this is also not nice because there's just too much information out there. So I'm saying I'm actively pursuing a line of thinking, argument, and logical conclusions. You're saying this is not a great idea.
It's tough, but there's an intelligent way about doing it.
Yes, I'm saying it's a mind-boggling exercise to figure out these things, do these things. We should not take it lightly. Somebody is putting a lot of time, energy out there, figuring out what is wrong about a company, what is good about a company. They're asking hard-hitting questions to the board, hard-hitting questions to the CEO. It must be done. And I don't see, I think the name has a wrong connotation. It's actually not at all a bad thing. It's part of functioning. You need three kinds of people: hedgers, speculators, arbitrage. Otherwise, what is a market? The market is where everyone only, when you need, then only you go and buy. How will you ensure that there is liquidity, there is price, correct pricing, things like that? Somebody has to be there at all times to ensure that price stick to a particular path. And that speculator, arbitragers, they have to ensure that at all times prices are available, they are liquid, it is for everyone.
Yes. Now coming to the end, what are your key takeaways from this? And would you like to summarize this for us?
So I will say that think about investment as a really long-term goal. It's not about buying something today, tomorrow, day after tomorrow, and making money in 15 days, 10 days, 3 months' time. When you are young, and we're a reasonably young country, and average age is 30. Most of the people who are in high income category actually are below 50. So you should think about a lifespan of 80, 85 years. And when you're entering a workforce at 25, you have 30, 35 years, 40 years to accumulate wealth that you are going to spend in the next 30 years after retirement. Think long term. And once you start thinking long term, then you have to keep certain things in mind. So first is think what is a very rapidly growing economy. So you have to keep that in mind, and accordingly you have to do your investments, adjustments, and things like this. Think about broadly 4 or 5 asset classes that we Indians have at this point in time. This may change over time. So at this point in time, you can go with fixed deposit, which is fundamentally for your liquidity needs in the short term. Once you have secured reasonable money in FD, then you should think about investment. And investment in the form of either equity or gold or bond. So if you think about risk category, bonds are the least risky. Then you can think about equity and gold. Equity and gold both are reasonably risky. So you have to think about how to allocate depending on your own risk preference. This should not come from somewhere else. You have to think about your risk appetite, your risk preference, how much risk you are comfortable with, and accordingly choose. Gold is not going to give you outrageous return, but it will give you a hedge against a lot of things, like inflation, like political instability, world market going down, and things like this. Equity, on the other hand, for a young country growing at a rate of 6.5–7%, is going to give you reasonably nice return if you remain invested for more than 15–20 years. So don't expect that in 3 years you will make money. You do a systematic investment for 15 years, it will give you outrageous money when you retire. But you have to keep a longer horizon. Don't think 3 months. Don't think about paying tuition fee using this money when you're in college. And then if you think at all points in time, keep a tab on what are the broad macro thing that is changing in this country. Overall, if you see that overall fixed deposit share in bank is coming down, this means people are doing more and more equity investment. If we are moving away from 4 trillion to $12 trillion economy, this means FD rate will come down from 10% to 6% to 4%. At some point in time, you may have to pay money for a bank account. And FD returns like US is less than 1%. You have to be ready that this is the world. It does not mean FD is a bad thing. It simply means that you have become a really big economy which cannot generate 7% real returns. It's just not possible. So it will slowly come down. So be ready for that transition and accordingly prepare yourself. Also, my final advice is always look at your overall portfolio So once in a year, take out 1 day, 2 day, 3 day of your time and look at your overall portfolio as an investor. It should contain all the wealth that you have accumulated so far and a projection of coming income and how you think about investing them. This will work out for you in the long run.
So thank you for being here. It was lovely to have you here. It was a wonderful conversation. Thank you.
It's lovely talking to a young, budding securities guy. Best of luck. I hope Investing Even will do great in the coming decade.